Goldman Sachs' trading desk, led by Chris Hussey, has issued a stark warning. The three pillars that powered the U.S. stock market's strong run over the past year, the AI dividend, cyclical recovery, and rate cut expectations, are crumbling simultaneously. The energy price surge sparked by the Iran conflict has become the key catalyst. With the S&P 500 already trading at a lofty 22x PE, market logic is shifting from buy the dip to risk control first. The AI dividend is shifting from a revolutionary narrative to disruptive pressure, with market expectations for AI cooling noticeably. Sector focus is moving from industry opportunities to the impact on traditional sectors and the extended timeline for returns. Software and AI-related growth stocks are bearing the brunt, facing concentrated selling. Tech giants' AI capital expenditures continue to climb, with Microsoft, Amazon, and others committing over $600 billion combined, but the pace of earnings delivery is falling far short of expectations. The divergence between valuations and fundamentals is widening, putting significant pressure on growth stock valuations. Cyclical recovery momentum has been severely undermined by the energy shock. Goldman estimates that every $10 increase in Brent crude shaves roughly 10 basis points off U.S. GDP growth. Higher oil acts as a hidden tax on households and businesses, squeezing disposable income and corporate profits, cooling both consumption and investment appetite. Unlike the brief June 2025 conflict, this episode appears more sustained, directly targeting the fragile spots in the economic recovery. Rate cut expectations are rapidly fading as the specter of inflation returns. A 10% rise in oil prices would push headline CPI up by roughly 28 basis points and core CPI by about 4 basis points. If oil stays elevated, May CPI could climb back toward 3.0%. The reemergence of inflation directly undermines the case for Fed rate cuts. Probabilities for June and July cuts have been slashed, and higher for longer is now market consensus. Long-end Treasury yields are moving up, further disrupting the valuation logic for growth stocks. The Iran conflict has been the key catalyst breaking market equilibrium. Oil prices have surged, with Brent jumping nearly $10 in a short period, briefly topping $82 and posting its largest one-day gain in 3 months. Due to reduced LNG supplies from the Middle East, Goldman has raised its European natural gas price forecast for the first half of 2026 by roughly 50%. The ultimate level and duration of oil prices hinge entirely on whether the Strait of Hormuz, a critical global energy artery, remains open. The escalation has triggered a cross-asset sell-off. The S&P 500 has broken below key support, with Nasdaq and Dow futures both down over 1%, led by tech growth stocks. Bond markets show a split, with long-end yields rising while safe haven flows concentrate in short-dated treasuries. Safe haven assets like gold and silver are strengthening, while cryptocurrencies are falling alongside risk assets. Markets have entered a phase where risk parity strategies are breaking down. Goldman's core assessment is that the near-term pattern for U.S. stocks is down first, then up. Only a full-fledged pullback can digest geopolitical risks and high valuation pressure. Historical data shows that in the 22 instances since 2000 where WTI spiked more than 10% in a single day, the S&P 500 posted a modest average decline the next day, but averaged gains 1 month later. Only an extreme sustained supply disruption, like a prolonged blockade of the Strait of Hormuz, would truly undermine the foundation of the bull market. Sectors and assets are showing sharp divergence. Energy, precious metals, utilities, consumer staples, and defense are direct beneficiaries. Tech growth, airlines, travel, retail, and oil-importing emerging markets face clear headwinds. On the investment front, near-term positioning should focus on controlling exposure, staying defensive, and holding off on bottom fishing. Medium-term, 3 key signals to watch: the status of shipping through the Strait of Hormuz, the March FOMC meeting, and May CPI data. Wait for de-escalation and cooling inflation before gradually deploying capital. Long-term, focus on quality names with AI earnings delivery, energy self-sufficiency, and robust cash flows to build a resilient portfolio. Overall, with the three pillars of the U.S. stock rally collapsing simultaneously, compounded by the energy shock from the Iran conflict. Markets have entered a phase of high volatility and low-risk appetite. Goldman's core conclusion is clear. A near-term pullback is unavoidable, but as long as there is no extreme energy supply disruption, the bull market's foundation is not entirely broken. After this correction, conditions for U.S. stocks to resume their upward path remain intact.